Hello friends, good evening to all of you and welcome to the learning sessions, and we are covering the CAIIB paper series in English only language, and I hope that you must have been going through the videos. Risk identification. First thing it's related to that whatsoever the different products are there or whatsoever the transactions that we are going to do, right? We should be analyzing those transactions so as to basically look into the different risks which may be associated with them. So as to look into the different risks which may be associated with them. Okay. So for the standard products, they are having the standard product programs. For the standard products, they're having the standard product program. Like for each product, there is a set of procedures, set of guidelines, limits, aspects. Those are to be looked into, and those are being specified by the risk management team, right? And they do provide a risk measurement at the individual level and also at the aggregate level, aggregate portfolio level. So that's for the standard products, right? And for the new products, or let's say non-standard products are there, those should be operating under a product transaction memorandum that on a temporary basis, right? So that a complete risk market risk product can be prepared. A market risk program can be prepared for them, right? So products must be approved by the team, by the risk management committee at all the levels. There should be proper screening of the product, particular safeguards should be there, right? And product-wise limits on the exposure and necessary guidelines are also to be taken care of, right? That's for the new products. And after that, it's related to the risk measurement. Means we are talking about the quantification now. And in this scenario, we do follow two parts. One, it's related to the sensitivity and others related to downside potential. We have already covered them both in the very first unit of the module B. In the very first unit of the module B, we have covered it, right? So measurement is related to what, that even if there is any slight variation, we need to capture that particular variation. We need to look into the uncertainties associated with them. Now, sensitivity, when we talk about, whenever we are talking about the sensitivity, there are multiple parameters. There are multiple parameters or multiple variables in the market which do change simultaneously and impose a risk in the form of market risk, right? Let's say case when I'm considering just a single parameter, let's say I'm considering just as interest rate and all others are said to be fixed, which is not a practical case also definitely, but let's say case I'm looking into the deviation into the market price due to the unit movement of a single market parameter. That would be what, that would be the sensitivity, because I'm looking into unit movement. Let previous interest rate was 6%, now I'm considering it to be 7%, and after that I'm considering it to be 8%, and I'm looking into it that what is going to be the price deviation. That would be the sensitivity. And there could be multiple parameters, like it could be the supply demand position, it could be interest rate, market liquidity, or anything, right? So sensitivity is measured as a change in the market value due to unit change in the variable, due to unit change in the variable. Now let's consider an example related to the sensitivity. So let's say case that market value of the portfolio changes by rupees 10 lakh for 1% change in the interest rate. So when the unit movement of the interest rate is there, the market value of the portfolio is changing by rupees 1 lakh, not 10 lakh, it is changing by rupees 1 lakh. That is actually what, that is a market risk. And it is representing what, it is representing the interest rate sensitivity of the portfolio. Okay. So a rise in interest rate is going to reduce the value by rupees 1 lakh, right? It means what, that the value is going to reduced by rupees 1 lakh when the interest rate is increasing, because I already told you that the interest rate and the bond prices are inversely related. Those are inversely related. So if there is increase by 1%, the bond prices will reduce by this much amount. And if there is decrease in interest rate, then there will be increase in the value. right? That's the scenario is. After that, it's related to BPV. BPV is also BPV is also related to sensitivity. But in case of the BPV, we are going to check for the basis point value, and one basis point is equal to 0.01%. Now, in the previous scenario, in the case of sensitivity, we were looking for unit movement like from 6 to 7%. But in this scenario, we are looking from 6.00 to 6.01% and so on, right? That is what? That is a basis point value. Basis point value. And this is used as a measure of the risk. Like, so let's say higher the BPV of the bond, higher is the risk associated with the bond. Simple as that. Let's consider an example related to it. So let's say the case that a 5-year 6% semi-annual bond. Now, are you able to understand what I'm trying to tell you about the bonds, right? Like in this particular scenario, it is told that 5 year is a maturity till the bond, and 6% semi-annual means it is a coupon that is given to be. In the previous example, when I told you about the coupon, we were taking the annual coupon. If it is not mentioned, we consider it to be annual coupon is to be paid. But it is clearly mentioned that 6% semi-annual bond. It means we are going to pay the coupon twice a year, half yearly basis, right? Market yield of 8% has a price of rupees 92. Now this 92 is the current market price of the bond. Rupees 92 is the current market price, which rises to 92.10, which rises to 92.10. It means that when the market yield was 8%, it is rupees 92. And when the interest rate reduced from 8% to 7.95%, the price changed from 92 to rupees 92.10. Now, this is the same relationship I just told you, that when there is decrease in the interest rate, definitely the bond prices are going to increase. Definitely the bond prices are going to increase. So that's the scenario, that the interest rates are decreasing. Interest rate is decreasing by 0.05% and the prices are increases by 0.10. But in case of basis point value, we have to look into the basis point movement, that is for 0.01%. 0.01%. So I can simply say if the interest rate is moving from by 0.01%, then the price movement would be of 0.02. Then the price movement would be by 0.02. And so same thing is told over here, that for 1 basis point fall in the yield, the market price change by 0.02 rupees or gain by rupees 2000 per 1 crore of the face value. So if we increase the face value to rupees 1 crore, then 0.01% would be related to what? It would be related to 2000 rupees for it, because for 1 basis point value, the change in the price of the bond is 0.02 rupees. 0.02 rupees, right? So that's related to BPV. And BPV changes with the remaining maturity. It changes with the remaining maturity, right? After that, it's related to the duration. Very important concept. Duration. Now, what do you mean by the duration? The concept of the duration was first of all proposed by the Frederick Macaulay. It was proposed by Frederick Macaulay in the year 1938. Now, if you hold the bond for the period of duration, the interest rate risk will cease. The interest rate risk will cease. So Macaulay duration is a weighted average time, or that is represented in years. So just keep in mind that the duration is represented in years, right? That basically is a weighted average time that is required to receive the cash flows of a bond. Weighted average time that is required to receive the cash flow of the bonds. And the formula for the duration is summation of PV dot T divided by summation of PV, where PV is representing the present value of the bond. It's representing the present value of the bond. Okay, so in short, we can say duration is representing the effective maturity of the bond, which do considers the timing of the cash flow and the magnitude of the cash flow, right? And this is equivalent to the average time that the bond holder of the bond must be waiting so as to receive the present value of the cash flows. right? So this is what, let me just showcase on you on the timeline. So this is 0, 1, 2, 3, 4 and 5. So let's say guys, we are having rupees 1000 bond, 8% coupon for 5 years. So what will be the cash flow? Rupees 80, 80, 80, 80 and 1080. Because in the fifth year, we'll be getting the face value, par value and also the coupon. So if we are to get the present value, we are going to reduce the value by the discounting factor. By the discounting factor, this value is to be reduced because the concept of the time value of money. Like if you're having rupees 25 lakh with you in today date and rupees 25 lakh with you after 20 years or 10 years or 5 years, would that be same? No, no, that won't be same. Why? The value today is weighing more than the value tomorrow, right? That's due to the inflation, right? That's due to the inflation. So we need to reduce the particular value. So we need to reduce the particular value. So this is the equivalent to the average time. This is equivalent, duration is equivalent to the average time that the bond holder must be waiting to receive the present value of the cash flow. That the bond holder must be waiting to receive the present value of the cash flow. So cash flows are rupees 80 per year, right? And first of all, we will be calculating the present value of the bond, right? And for the particular time, for what particular time we should be waiting that we receive the present value of all the cash inflow. So what some of the cash inflows are there, like 80, 80, 80 for the 5 consecutive years and 1000 at the end of the tenor. We should be at, for what particular time we should be waiting that we are going to receive the present value of these cash flow inflows, and that particular time is lesser than the total maturity to the bond. Total maturity to the bond. Let's say case, for this case, let's consider the duration is 3.9 years. Let's just consider it is 3.9 years. Now the duration is given to be 3.9 years, but the maturity is 5 years. So if you're going to hold the bond for 3.9 years, after that the interest rate risk will cease because you have already received the present value of the cash inflows. You've already received the present value of the cash inflows. So that's the concept related to the duration. And it is basically mentioned in years. Duration is there mentioned in years, right? Is that clear to you? And there is a concept of modified duration also. Modified duration concept is also there, and modified duration is equal to d divided by 1 plus small r. D is duration and or r value is equal to YTM, yield to maturity, divided by the frequency of the coupon, right? So these are the formulas, and how to solve this thing, we'll be solving a numerical based upon it, don't worry. And moreover, longer is the duration of the security, we can say longer is the price risk sensitivity, means more is the risk associated with it. So simple say, more the duration is, more is the risk. And when any of the particular asset or security approaches the maturity, the duration of the bond almost becomes equals to the maturity of the bond, right? Or we can say simply the duration approaches maturity, right? That's the case. Now let's have a look at the properties of the duration. So duration is less than the term to maturity. That's the first case. I already told you, like let's say for 5 years, the duration is 4.5, 3.9 or something like that. And bonds duration would be equal to the term to maturity only if it is zero coupon bond, because in case of zero coupon bond, no coupon is paid, no coupon amount is paid. So interest rate is already not there, right? And if it is no interest rate risk is there, then the duration of the bond is equal to the maturity of the bond. And also, if we do increase the frequency of the coupon, right, that is going to decrease the duration. That is going to decrease the duration. Let's say case one coupon is there, amounting rupees 1000 with the 5 years till maturity and 8% of the coupon, but half yearly basis. And the same bond is there, like for 1000 rupees bond, 5 years maturity and 8% coupon on annual basis. On annual basis. For both of these scenarios, for which particular bond? Bond A is going to have the lesser duration or bond B is going to have the lesser duration? Do answer at the earliest. Which bond is going to have the lesser duration? Definitely the bond B is going to have the lesser duration because the frequency is more in this case. Frequency of the coupon is more in this case, right? And the duration of the bond declines as a bond approaches duration. The duration of the bond will decline as the bond approaches a maturity. Now let's solve a question based upon it. Let's solve a question based upon it. So it says the bank ABC held a bond with the price of a face value of rupees 100. Coupon rate is given to be 8%, paid yearly. Maturity after 5 years. YTM yield to maturity is given to be 6%. Calculate the duration of the bond. Now YTM is what? YTM is that particular discount rate. This is a discount rate. YTM is a discount rate. And which discount rate? YTM is that discount rate at which the present value of the cash inflows. So what sort of the cash inflows are there? The present value of those cash inflows is going to become equal to the current market price of the bond. That is the YTM. That is a YTM. Okay. So we are provided the face value, or we say it to be the par value, one and same thing, that is given to be rupees 100. Further coupon rate, it is given to be 8% and is being paid yearly basis. Maturity till the bond or N is given to be 5 years. It is given to be 5 years. Now what will be the amount of coupon? Coupon is always calculated on the face value of the bond. So 8% of rupees 100, that is rupees 8. That will be the coupon that will be paid. And if I draw it on the timeline, that will be 1, 2, 3, 4 and 5. The person will be getting rupee 8 for the 4 years. And in the end, the person will be getting 100 rupees as the face value, maturity value, and also rupees 8 as coupon. So 108 would be paid at the end of the tenure, right? Now, whenever we are to solve a question based upon the duration, which will definitely be coming in the form of a case study question, you have to make 5 columns. And the first column would be related to time, that the time when you will be getting the cash inflow. Like for this case, the coupon is to be paid on yearly basis. So we'll be having the time as 1, 2, 3, 4 and 5. 1, 2, 3, 4 and 5, right? That's the first column. B would be the representing the cash flow. We are getting the cash flow, rupees 8 for the first year, 8 for the second year and so on. The third column would be the present value factor, PVF factor, or we simply say to be discounting factor. Now, how we do calculate the discounting factor or the PVF? PVF or the discount factor. The formula is quite simple. Let me just tell you the formula. This is 1 divided by 1 plus R raised to power N. And whenever we are to consider the discounting rate, I told you YTM is the discount rate. That is the small r, right? That is to be considered. Okay. So will be considering R to be 6%. That is 1 divided by 1 plus 6% means 1.06. Converting it into decimal form. And we have to change the value for the different years. Now for the first case, the value of N would be equal to 1. For the second case, it will be equal to 2. N value would be 1, 2, 3, 4 and 5. That would be the value of the N for the different cases. Is that clear? Okay. That is the third column. That is a present value factor. And the fourth column D, that would be equal to multiplying the column B and C. B and C we have to multiply. And the E column, that would be equal to, we have to multiply A with D. We have to multiply A with D. So these 5 columns are to be prepared, right? I've already prepared the table for you. Let's have a look at it. So we are having the time period as 1, 2, 3, 4 and 5. We are also given with the cash flows. We have already calculated the cash flows. In the first year, we are going to have rupees 8 till year 4th. And in the last year, we are going to have the maturity of rupees 100 as well as the coupon, that is 108. And we calculated the present value factor. For the first year, the present value factor is 1 divided by, as per the formula, 1 divided by 1.06. So 1 divided by 1.06, that is 0.94. For the second year, it would be equal to 0.889, that is 0.89. For the third year, I'm calculating it side by side, right? 0.8396, that is 0.84, 0.79, 0.75, that's it. And for the fourth column, we have to multiply B with C. 8 multiplied by 0.9, 8 multiplied by 0.89, and so on. We calculated these values, right? And this is basically what? This is your sigma PV. This value is representing your sigma PV, because we are here, here is a present value of the cash inflow. Here is a present value of the cash inflow. And when we will be adding up all the cash inflows present value, we'll be getting the present value of the bond. We will be getting the present value of the bond, right? And here it is summation of PV, or we can simply say A into D is actually equal to what? It is PV dot T, right? Because T, here the A column is T, and this E column over here is PV, that is a present value dot T. We are doing this case. So D column is PV. So we are multiplying PV with T, that is PV dot T, right? So here we get the total 470.80. What is the formula for duration? It is summation of PV dot T divided by summation of PV. This is the formula. And this is the duration that we calculated. And it came out to be 4.34 years. Right? And now we have to calculate the modified duration. Now the first question they will be asking you in the exam would be related to the what is the present value of the bond. What is the present value? It is 108.42. The second question they can be asking about the what is the duration. So it will be 4.34 years, right? And the third question they may be asking about the modified duration. What will be the value of modified duration? Formula is D divided by 1 plus R, where R is equal to YTM divided by the frequency, that is N, frequency of the coupon, right? So it is YTM divided by N. So YTM is 0.06, that is 6%, and N is equal to 1 because we are going to get the coupon annually. So it is 1. So it will be 4.34 divided by 0.06 divided by 1 plus R means 1.06, right? So here we calculated it to be 4.094. This is a modified duration. This is a modified duration that we calculated, right? Further, there is a very amazing formula that you should be looking into, and that's related to approximate percentage change in price. And that's the modified duration multiplied by the yield change, and the minus sign is there. Make sure to put this minus sign, right? So the formula is modified duration into yield change. So let's say the case that the previous yield was 6%. And let's say case now it's changed to 7%. Previously it was 6%, but now it is 7%, right? I'm just making up the question for you. So what will be the approximate percentage price in change? So modified duration is 4.094 multiplied by yield change is by 1%. Previously it was 6%, but now it is 7%. So the change is there, that is 1%. So it is 4.094%. 4.094%, right? Now what does this indicate? Now if the yield is increased, percentage change, it will be 7 minus 6%. If the yield is increased, I told you na, that if the interest rate increases, in that scenario the bond prices will decrease. The bond price is going to get decreased, right? Now in this scenario, the interests are increasing or decreasing? Those are increasing. Previously it was 6%, but now it is 7%. The bond price will reduce. That is also reduced by 4.094%. So that could be your question number 3. That could be your question number 3. That what is the modified duration, and what would be the approximate percentage price change? And the fourth question, it could be related to that what will be the new bond price, and what will be the new bond price? Previous bond price was, we calculated already, it is 108.42. Previous one was 108.42, And now we are to reduce this value by 4.094%. And that will be the answer. So it is 108.42 minus 108.42 minus 4.094%. That is 103.98. That will be the new bond price. Is that clear? Right? So that will be all about today video. I hope that you must have understood the concepts related to it. So if there is any doubt related to today's session, if you want to get the PDF of today's session, if you want to get the complete course of the CIB, simply just do WhatsApp CAIB to the number 83609 and I'll be sharing all the details with you. So thank you so much and see you again in the next video.